Welcome back to the Wall Street Podcast. Today, we're doing a deep dive into Tesla Inc.'s Q2 2025 performance. Our analysis is based on the Goldman Sachs TSLA Q2'25 first take report, which just came out yesterday, July 23rd, 2025.
Right, and this report, it gives us that really important first look at Tesla's Q2 financials. It covers the key metrics, naturally, segment performance, what Tesla themselves are saying about growth and new products, and importantly, it includes Goldman's own outlook and the risks they see for investors.
Okay, so our mission is clear. Get through the noise, get to the core insights in this GS report. Let's start right at the top. Goldman's initial take was that the results were, quote, better than we had expected. What numbers back that up?
Yeah, better than expected is the headline. So the non-GAAP EPS, excluding stock-based comp, that landed at $0.40. That was right in line with the FactSet consensus, but significantly, it was above Goldman's own $0.35 estimate.
Right.
Revenue came in at $22.5 billion. That's about 1% above FactSet, 2% above Goldman. And free cash flow, always a key one, was $146 million.
Now, what drove that outperformance?
Well, the report flags better revenue, mainly, and higher gross margin. That was partially offset by higher OpEx operating expenses, but still a beat overall.
That gross margin point is interesting. Let's dig into that a bit more. Margins tell us a lot about pricing power, cost control. How did they look across the different segments? What really stood out there?
The margin story is quite strong this quarter. If you look at automotive non-GAAP gross margin, so that's excluding regulatory credits, and SBC, it came in at 15.0%.
15%?
15. And that was, well above expectations. GS was at 12.7%, FactSet around 13.8%, Visible Alpha 13.6%, so a solid beat. It was also up from 12.5% in Q1, and the main driver there was a stronger vehicle average selling price, the ASP.
Right.
Now, what's really striking is the energy gross margin. It hit 30.3%.
Wow, 30%.
Yeah, way above Goldman's 23.0% estimate. It actually made energy Tesla's highest margin business in Q2. Suggests really strong profitability in energy storage. Overall, total company gross margin, including SBC, was 17.2%. Also beat the street. One thing to note, though, cost per vehicle did tick up a bit sequentially. Roughly $35.09K from $35.05K in Q1.
Okay, so energy really punching above its weight on margins. Now let's connect that to revenue. Where did the total $22.5 billion come from? How did the segments perform compared to last year?
So total revenue, $22,486 million, let's be precise. That's up 16% quarter over quarter, which is good momentum. But importantly, it's down 12% year over year. That's a trend we need to watch.
Down 12% UI, okay.
Automotive revenue was the bulk of it, $16,661 million. That followed the company trend, up 19% sequentially, but down 16% year over year. The implied vehicle ASP, around $41.08, that was higher than Goldman expected, supporting that margin story we just discussed. Regulatory credits were $439 million, down a bit. Energy generation and storage revenue was $2,789 million. That was up just 2% sequentially and actually down 7% year over year, despite those, really strong margins. Storage deployments were 9.6 GWh.
So revenue down slightly year over year in energy, but margins way up.
Exactly. And then finally, service and other revenue, $3,046 million. That showed pretty healthy growth both quarter over quarter and year over year, up 15% and 17% respectively.
Okay, so a bit of a mixed bag on revenue growth year over year, but strong ASPs in auto and those standout energy margins. What about the nuts and bolts vehicle production and deliveries? What were the volumes?
Right, the volumes. Total vehicle deliveries were about 384,000. That's up 14% from Q1, so some sequential recovery, but still down 13% compared to Q2 last year.
Okay.
Model 3 and Y made up the vast majority, around 374,000 deliveries. That segment was up 15% QQ, but down 12% YoY. The other models, SX Cybertruck, that was only about 10,000 units, down 19% sequentially, and quite sharply down 52% year over year.
52% drop YoY for the other models.
Yeah, significant. Now, production tells a slightly different story.
Yeah.
Total vehicle production was around 410,000 units. That's up 13% quarter over quarter, similar to deliveries, but critically, it was roughly flat year over year.
Flat year over year production, but deliveries down 13%, so inventory build.
That's the implication, yes. Production holding steady while deliveries face more headwinds year over year. Something to watch.
Definitely. Okay, looking ahead now. What did Tesla actually say about its strategy, its outlook for the rest of 25 new products?
Well, they flagged ongoing policy uncertainty, said it makes it difficult to predict growth rates for both auto and energy. This kind of follows their Q1 move, where they withdrew guidance citing macro and tariff issues.
Right, that uncertainty theme continues.
It does, but despite that caution on overall growth, they did reaffirm plans for new vehicles in 2025. They're still saying initial production of a more affordable model in the first half of 25, then volume production ramping in the second half.
That timeline is holding then.
Seems so. They also unveiled the Model YL, the longer Model Y, with deliveries expected in China this fall, and other things like lithium refining, cathode production, domestic LFP cell production for energy storage later this year, all apparently remain on track for 2025.
So commitments on specific projects, but caution on the overall growth rate. How does that square with Goldman's view?
Well, Goldman Sachs is sticking to their forecast of an 11% year-over-year decline in Tesla vehicle deliveries for the full year 2025. That's actually a bit more pessimistic than the Visible Alpha consensus, which is around an 8% decline.
Okay.
And Goldman notes that things like robotaxi progress, FSD development, the actual impact of new models and tariffs, those will be key drivers for the stock going forward.
That makes sense. Okay, that's a great overview of the report's findings. Let's take a step back and explore a few key themes. First, those margins. The automotive non-GAAP margin was strong, sure, but that energy margin was exceptional. Beyond just ASPs and auto, what really drove this resilience, especially with revenue down year over year in some areas?
Well, yeah, the ASP was key for auto, but the energy story is more about, I think, execution and demand. Hitting over 30% gross margin there, significantly beating estimates, it suggests they're managing costs well in that segment, and that demand for storage products is robust. This happened even with, all the talk about potential tariff headwinds that were expected to hit energy margins, so they navigated that better than anticipated.
So operational strength in energy.
It seems so. It really highlights how the energy business, while smaller on the revenue side than auto, is becoming a critical profit contributor. It provides a sort of ballast against the perhaps greater volatility in the auto market right now.
A strategic diversification playing out in the numbers. Okay. Second point. This tension between policy uncertainty impacting the overall growth outlook and the firm commitment to new vehicle timelines for 2025. Can you elaborate on those specific launches, the affordable model, the Model YL, and how this company view contrasts with what analysts are actually forecasting for deliveries? It seems like a disconnect.
Right. It is a bit of a contrast. So on one hand, Tesla is saying, look, policy makes overall growth hard to predict. They pulled specific growth guidance, but on the other hand, they're quite firm. Affordable model, initial production 1H 2025, volume 2H 2025. Model YL deliveries in China this fall. Those are concrete milestones.
Okay.
The disconnect is that analysts, like Goldman forecasting an 11% decline in deliveries for 2025, aren't yet seeing those new products as enough to offset broader market pressures or deliver growth this year. So the company is signaling catalysts are coming, but the consensus forecast for now remains cautious, modeling a contraction. The question is timing. How quickly can these new models impact volumes significantly?
Right. Bridging that gap between product roadmap and market reality. That's key. Finally, let's look beyond operations of the broader financial picture from Q2. Free cash flow, cash balance, inventory levels. What do these tell us about Tesla's financial health right now? And crucially, what are the main risks Goldman Sachs is flagging for investors?
Okay, so free cash flow was positive at $146 million. Positive, but, relatively modest for a company of Tesla's size. Their cash equivalents investments dipped slightly, down near $0.2 billion from Q1, but it's still very substantial at $36.8 billion. Plenty of liquidity.
Yep.
Inventory, though, did increase. Inventory dollars rose by about $9 billion to $14.6 billion.
Which connects back to that production versus delivery gap we mentioned.
Exactly. It could indicate slowing sales or maybe building stock ahead of demand or model changeovers. It's something analysts will definitely be watching. As for risks, Goldman highlights a few key ones. On the downside, potential for more vehicle price cuts, rising EV competition, tariff impacts, just general slower EV demand, and any delays in FSD or, say, 4680 battery development.
Standard concerns.
Pretty standard, yes. On the upside, they see potential from faster overall EV adoption, a stronger macro environment than expected, maybe earlier than planned new product launches, and the big one potentially, significant breakthroughs or impact from AI-driven products like FSD and robotaxis.
So it's that classic tech story. High potential reward balanced against execution and market risks.
Precisely. It's about balancing those external market forces against Tesla's own internal technology and product execution.
Okay, we've covered a lot of ground here, really dissecting that Goldman Sachs first take on Tesla's Q2. We've hit the key financials, the operational numbers, and the strategic outlook.
Yeah, I think the report really underscores that margin strength in Q2, especially as we discussed in the energy segment. It also confirms those new model timelines are holding for now, even with the broader uncertainty around growth rates. It really frames the ongoing challenge for Tesla, balancing that internal execution on products and costs against these external factors like policy and market competition.
So the core takeaway for you, the listener, is really that persistent tension. You have strong performance in specific areas like energy margins, rubbing up against these broader policy-driven market uncertainties. As always, it's crucial to consider how this interplay might shape your own view of market trends and where individual companies like Tesla might be headed in this very complex landscape.